Your portfolio is being destroyed right now. You don't see it yet, but it's happening. 5 mistakes. Silent killers. They're costing you thousands, tens of thousands, maybe hundreds of thousands, and you're making at least 3 of them. January 2025. Markets at all-time highs. Portfolios look healthy. Everyone feels rich. But beneath the surface, 5 deadly errors are compounding. Invisibly, relentlessly. Let me show you what they are. Because in 2000, investors who made these mistakes lost 50%. In 2008, they lost 57%. In 2025, if you're making these mistakes, you'll lose everything you've gained and more. This isn't theory. This is documented pattern. And right now, at this exact moment in the market cycle, these 5 mistakes are more dangerous than they've ever been. I'm going to show you each one, exactly how it destroys wealth, and exactly how to fix it before it's too late. Because once the crash comes, it's too late. The damage is done. You're about to see the 5 mistakes destroying portfolios in 2025. And if you recognize yourself in even one of them, this video might save your financial future. Let me take you back to March 2000, the dot-com bubble peak. An investor named Tom had a portfolio worth $500,000. Tech stocks, internet companies, the future. Everyone said stocks only go up. Tom made 5 critical mistakes. By October 2002, his portfolio was worth $150,000. He lost 70%. Tom didn't lose because he was unlucky. He lost because he made the same 5 mistakes millions of investors make at market peaks. Fast forward to 2007. Different investor, same mistakes. Sarah had $800,000 in her retirement account. Real estate stocks, financial sector. Everything looked perfect. By March 2009, she had $320,000. Down 60%. Different bubble. Same mistakes. Same outcome. And right now, in 2025, I'm watching investors make these exact same 5 mistakes. The market is at record highs. Confidence is extreme. Everyone thinks they're a genius. And the 5 deadly mistakes are compounding in portfolios everywhere. Here's what most investors don't understand. Mistakes don't hurt during bull markets. They compound silently. You feel rich. Your portfolio is growing. Everything seems fine. But you're building a house of cards. And when the market turns, the house collapses instantly. These 5 mistakes are like structural flaws in a building. The building stands during calm weather. But when the earthquake comes, it falls. And right now, we're in the calm before the earthquake. Let me show you the 5 mistakes, one by one, how they work, why they're deadly, and how to fix them before the market turns. Because it will turn. It always does. And when it does, these mistakes will be exposed brutally. Mistake number 1, chasing performance. This is the most common mistake and the most deadly. Here's how it works. You see a stock or fund that's up 50% in the past year. You think, this is a winner, I need to own this. So you buy. You just bought at the peak. Performance chasing is buying what's already gone up because it went up. It feels smart. It's actually guaranteed wealth destruction. Here's why. Assets that have risen the most are the most expensive and the most likely to fall. When you chase performance, you're buying high. The only way to profit is to sell higher. But you just bought from someone who already made the profit. You're the exit liquidity. In 2000, investors chased tech stocks that had risen 400%. They bought at the peak. Those stocks fell 80%. In 2007, investors chased housing and financial stocks. Peak prices. Those stocks fell 90%. Right now in 2025, investors are chasing AI stocks, cryptocurrency, and whatever's been on CNBC. They're buying at record valuations. They're about to learn the same painful lesson. Here's the fix. Never buy something because it went up. Buy based on value. Is this asset cheap relative to its fundamentals? If not, don't buy it, no matter how much it's already risen. Mistake number 2, portfolio concentration. This is when too much of your wealth is in one asset, one sector, or one strategy. In 2000, investors had 80% of their portfolios in tech stocks. When tech crashed, their entire portfolios crashed. In 2007, investors had massive exposure to real estate and financials. When those sectors collapsed, portfolios were destroyed. Right now in 2025, I'm seeing portfolios with 60, 70, 80% in technology stocks. Nvidia, Microsoft, Apple, Tesla, AI companies. If tech corrects 50%, these portfolios lose 30 to 40% of their value. Here's the brutal truth about concentration. It works great in bull markets. Your concentrated bet goes up, you make huge gains, you feel like a genius. Then, the market turns. Your concentrated position falls 50, 60, 70%. Your portfolio is destroyed. You can't recover. Diversification is the only free lunch in investing. Spreading risk across uncorrelated assets means no single collapse destroys you. Yet investors abandon diversification at peaks. They concentrate in whatever's working. Then it stops working. Here's the fix. No single stock should be more than 5% of your portfolio. No single sector more than 25%. If you're overconcentrated, rebalance now, while you can still sell at decent prices. Mistake number 3, ignoring valuations. Valuation is the relationship between price and value. When stocks are expensive relative to earnings, cash flow, or assets, valuations are high. High valuations predict low future returns. This is not opinion. This is mathematical certainty. The Buffett indicator measures total stock market value relative to GDP. Historically, sustainable levels are around 80 to 100%. Above 120%, stocks are expensive and likely to fall. Right now, the Buffett indicator is at 185%, the highest level ever recorded, higher than 2000, higher than 2007. Stocks are priced for perfection. Any disappointment triggers collapse, but investors ignore valuations. They say, this time is different. AI changes everything. The Fed supports markets. Valuations don't matter anymore. They said the same thing in 2000 about the internet. They said it in 2007 about real estate. They were wrong both times. Valuations always matter. Here's why. If you buy stocks at 185% of GDP and they revert to the mean of 100%, you lose 46%, even if the economy doesn't crash. You just paid too much. The math doesn't work. Here's the fix. Check valuations before buying. If the market or sector is historically expensive, reduce exposure. You'll miss some gains at the top, but you'll avoid the crash. Mistake number 4, using leverage. Leverage is borrowing money to invest more than you have. Margin debt, leveraged ETFs, options. Anything that amplifies returns also amplifies losses. In 2000, margin debt reached record levels. When the market fell 10%, leveraged investors got margin calls. They were forced to sell. That selling drove prices lower, triggering more margin calls. Death spiral. In 2007, leverage wasn't just in stocks, it was in housing. People bought houses with 3% down. Massive leverage. When prices fell 20%, homeowners were underwater. Foreclosures cascaded. Right now in 2025, margin debt is near record highs again. Retail investors are using options and leveraged ETFs without understanding the risks. When the market falls, leverage will amplify losses catastrophically. Here's the danger of leverage. It makes you fragile. A 10% market decline becomes a 50% portfolio loss with 5 times leverage. You can't survive volatility. One bad week destroys you, and you're forced to sell at the worst possible time. Here's the fix. Never use leverage in your core portfolio. If you don't fully understand options, margin, or leveraged products, don't use them. The risk is not worth the reward. Mistake number 5, emotional decision-making. This is the master mistake that enables all the others. Investors make decisions based on fear and greed instead of logic and discipline. When markets rise, greed takes over. Investors chase performance, concentrate portfolios, ignore valuations, use leverage. When markets fall, fear takes over. Investors panic sell at the bottom, lock in losses, miss the recovery. This cycle repeats every single time. and it destroys wealth systematically. Behavioral finance studies show that the average investor underperforms the market by 4 to 5% annually. Not because they pick bad stocks, because they buy high and sell low. Emotionally, here's what happens. Market rises, you feel confident, you buy more, you increase risk. Market falls, you feel panic, you sell, you go to cash. You bought at the top, you sold at the bottom. You guaranteed losses. Right now in 2025, investor confidence is at extremes. Everyone feels like a genius. Risk-taking is at record levels. This is the greed phase. When the market turns, panic will set in. Mass selling will begin. And the same investors who bought at the top will sell at the bottom. Here's the fix. Make decisions based on rules, not feelings. Set asset allocations in advance. Rebalance mechanically. Never make investment decisions when you're emotional. Fear and greed are the enemies of wealth. Now let me show you what happens when these 5 mistakes collide with a market crash. Because we're not talking about hypotheticals. This is the documented pattern from every crash in history. Phase 1. The setup. Investors make the 5 mistakes during the bull market. They chase performance, buying high. They concentrate in hot sectors. They ignore record valuations. They use leverage. They make emotional decisions based on greed. Their portfolios look amazing. They're up 30, 50, 100% in a few years. They think they're wealthy, they think they're smart, but they've built a fragile house of cards. Phase 2, the trigger. Something causes the market to fall 5 to 10%. Could be anything. Interest rates, earnings disappointment, geopolitical shock. The specific trigger doesn't matter. What matters is what happens next. Phase 3, the cascade. Leveraged investors get margin calls. They're forced to sell. That selling drives prices lower 10%. Now investors who chased performance are underwater. They bought high, prices are falling, they panic. They sell. More selling. Prices fall to 20% down. Now, concentrated portfolios are getting destroyed. Tech-heavy portfolios down 30%. Investors who ignored valuations realized stocks were too expensive. They sell. Prices fall 30%. Now fear takes over completely. Emotional investors panic. They sell everything. They go to cash, mass liquidation. The market falls 40, 50, 60%. Phase 4, the bottom. At maximum panic, when everyone has sold, when fear is absolute, the market bottoms. The investors who sold at the bottom have locked in catastrophic losses. They'll never recover. Phase 5, the recovery. Markets begin to rise, but the emotional sellers are in cash. They're too scared to buy back in. They miss the recovery. They bought high in Phase 1. They sold low in Phase 4. They missed the recovery in Phase 5. Wealth destroyed. Permanently. This exact pattern played out in 2000 to 2003. It played out in 2007 to 2009. It played out in 2020. And it's going to play out again. The 5 mistakes create the fragility. The market turn exposes them. The cascade destroys wealth. And right now, we're in Phase 1, the setup phase. Investors are making all 5 mistakes at scale. Record performance chasing. Record concentration. Record valuations ignored. Record leverage. Record emotional greed. The 5 mistakes are primed. The only question is when the trigger comes. Not if. When. Let me show you exactly what these 5 mistakes cost in real dollar terms. Because this isn't abstract. This is your retirement, your financial freedom, your future. Let's take a realistic example. You have a $500,000 portfolio in 2025. You're making the 5 mistakes. Mistake 1, you chased AI stocks that are up 100%. You bought at peak valuations. Mistake 2, you're 70% concentrated in technology. Mistake 3, you ignored that tech stocks are trading at 40 times earnings, double historical averages. Mistake 4, you're using a 2 times leveraged tech ETF to amplify gains. Mistake 5, you're making decisions based on excitement and greed, not discipline. Your portfolio is up huge. You feel rich. You're planning early retirement. Then the crash comes. Tech stocks fall 50%. They're not cheap yet, just returning to normal valuations. Your 70% tech position is now worth 35% of your portfolio value. That's a $245,000 loss. But you had leverage. Your 2 times leveraged position falls 100%. Total loss on that position. Another $50,000 gone. Now you panic. You sell everything to stop the bleeding. You lock in a 60% loss. Your $500,000 is now $200,000. You sold at the bottom because fear overwhelmed you. Markets recover over the next 2 years, but you're in cash, too scared to reinvest. Stocks double from the bottom. You miss it entirely. Your $200,000 stays $200,000. Meanwhile, disciplined investors who avoided the 5 mistakes, they had diversified portfolios, they bought value, not performance. They used no leverage. They rebalanced mechanically. They bought during the crash while you were selling. Their $500,000 fell to $350,000. A 30% decline, painful but survivable because they were diversified and didn't panic. Then they bought more at the bottom. Their $350,000 recovered and grew to $700,000 in 2 years. You have $200,000, they have $700,000. That's a $500,000 difference. The cost of the 5 mistakes. This is an exaggeration. This is what happened to real investors in 2000 and 2008. And it's going to happen again to anyone making these mistakes in 2025. Here's the brutal truth. Most investors are making at least 3 of these 5 mistakes right now. And they don't know it, because mistakes don't hurt in bull markets. They feel good. Chasing performance feels smart because prices keep rising. Concentration feels smart because your bet keeps winning. Ignoring valuations feels smart because stocks keep going up. Leverage feels smart because gains are amplified. Emotional decisions feel right because confidence is high. But this is the illusion. The mistakes are compounding silently. And when the market turns, they'll be exposed instantly. Here's what you need to do. Right now. Before the crash. 1. Stop chasing performance. If you own something only because it went up, sell it. Buy value, not momentum. 2. Diversify. If any position is over 5%, any sector over 25%, rebalance. Spread risk. 3. Check valuations. If the market or your holdings are at record multiples, reduce exposure. You'll miss the top. You'll survive the crash. 4. Eliminate leverage. Pay off margin. Sell leveraged products. Reduce fragility. Make your portfolio anti-fragile. 5. Make rules and follow them mechanically. Decide your asset allocation now while you're calm. Rebalance quarterly. Never make decisions while emotional. These 5 fixes don't guarantee profits, but they guarantee survival. And survival is how wealth is built. Because the investors who survive crashes are the ones who buy assets from the panicked sellers at the bottom. That's when generational wealth is made. But only if you survived. If this warning opened your eyes to mistakes you're making right now, subscribe to the Wealth Forum. Because over the next year, as these mistakes get exposed, we'll track every signal, every warning sign, every step of the crash pattern. You'll see it coming. You'll be prepared. Drop a comment below. Which of the 5 mistakes are you making? Performance chasing, concentration, ignoring valuations, using leverage, or emotional decisions? Because the first step to fixing a mistake is admitting you're making it. The second step is acting before it's too late. And the third step is surviving the crash so you can buy at the bottom. This is the Wealth Forum. Exposing mistakes, protecting wealth, building anti-fragile portfolios.